and objective questions for BFM. Today we'll be covering an important numerical on foreign exchange. Very important. Remember, this numerical is asked for 5 marks in the exam. 5 marks. It's a case study for 5 marks. Okay, so don't miss this. Okay, let's start. Only here, this is one case study, but this case study will cover 5 marks. It's that important. Let's start. See this. I'll explain you in details how it is to be tackled, what are the basics of this case study. On 15th September, a customer requested for booking a forward contract for export bill for USD 1,50,000 to be realized in the month of December. Okay. Given that USD INR rate is 75.45 and 50, forward premium is as under. What is the forward premium? October is 18-19 paise, November is 30-32 paise, December is 41-43 paise. Margin to be charged is 0.05 paise per USD. Calculate the forward rate to be quoted to the customer. So this much is the question. So this question will be asked in exam for 5 marks. And they'll ask you various 5 questions on this. We'll discuss all these questions and all these topics over here. So understand what is happening first. It is export bill. What do you mean by export bill? This is the export bill. Export bill means what? Somebody is exporting the goods, right? And this guy will get the payments. Here, export rule is what? There is a seller in India or exporter in India, right? This guy sells the goods and gets the dollars. Okay, gets the dollars. Dollars means it can be dollar or any other currency. Mainly dollars. Okay, so this guy sells the goods and there is a buyer in, let's say, USA, right? Buyer in USA, and this guy is in Bharat. Okay, so this guy is in Bharat and there is a buyer in USA. So what happens now? This guy sells the goods and this guy gets the dollars. So whenever we do the export transaction, the dollars are coming in for the seller. So bank has always to which type of transaction should the bank do in this? Bank should always buy the dollars. Okay, will always buy the dollars. And in import transactions, import. Bank will always sell the dollars. Okay, sell. In export, bank will always buy, and in import, bank will always sell, right? So now what we'll do? It is an export transaction, so we'll buy. Okay, so this is our first step. Done. Now in this first step, remember, there is an export bill. Now again remember, there are 2 types of bills, 2 types of rates. One is TT rate and second is this bill rate, bill. There are other rates as well. There is a cash rate, there is a traveler's checks, TC rate. Okay. Then there is TT rate, then there is a bill rate. So cash rate and this TC rate, we won't consider it now because this is not applicable in this problem. Okay. Cash rate is applicable when you are dealing with the cash notes of the dollars or any currency. TC is when you are dealing with the traveler's checks. These are separate rates. Okay. So now coming back over here, TT rates. Okay. So now which rate will I apply? Will I apply the TT rate or will I apply the bill rate? So remember, TT rate is always applied when we are doing the transaction on the same time. Same time, no time difference. I'll write it simple, same time. Okay. If I'm doing the transaction at the same time, then I'll be applying the TT rate. And what is the bill rate? Bill rate I'll be applying when I'm doing, I'll write it over here, right? Bill. Bill rate I'll be applying when I am doing a future dated transaction. Future dated. Okay. So now in this case, which type of transaction are we doing? Are we doing the same time transaction or are we doing the future dated? Let's look at the problem again. On 15th September, see the date is 15th September. This guy has come to you. This customer has come to you. Okay. For booking a forward contract for export bill to be realized in the month of December. So this is a future dated transaction. You are doing a transaction for the month of December. Okay. So now, yeah, before going ahead, everyone subscribe to Officers Adda 24/7 YouTube channel. Just pause this video and subscribe it immediately. Okay. In this channel, you will be getting the latest updates on JIB and CAIIB, number 1. Number two, you will be getting all the free YT series, free YouTube series. Right now, what are you watching? This numerical. You're watching the free YouTube series. So these free YouTube series, you'll be getting it over here. So that's why subscribe to it immediately. On all the subjects you'll be getting. Subscribe to the Officers Adda 24/7 YouTube channel right now. Click on the bell icon, click on the like button, share it with your friends. Okay. So let's move on. Yeah. So now, what was that numerical? It was in September and it is for the month of December. Now look at this. We'll draw it over here. This transaction is happening on 15th September. I'll draw it over here. 15th September. And then it is for the month of December. See here, now understand one important point over here. It is maturing in the month of December. So in the month of December means what? See here, December is over here. So it is starting from December 1 to December 31. And this transaction is maturing in between. So it can be, let's say, December 10th. We'll take assumption. Okay, December 10th. So this December 10th, when I am having this transaction, it is within the month of December, year and year, right? So if I am having it in between, now what will I do? Whenever you have any transaction which is falling between, so you'll always use one maxim that is called as buy low and sell high. You'll always use this maxim, buy low and sell high maxim. Okay. Now what does this mean? Buy low, sell high. Between the rates of 1st December and 31st December, I'll have to choose the lower rate for buying and I'll have to choose the higher rate for selling. Okay. But what is this rate? How to get this rate? So look at these rates now. We'll draw it over here. Below this, I'll write it. Okay. 15th September. So first take the spot rate. What is the spot rate given? Look at this. 75.45 and 50. So this is my spot rate. So which one will I take? 75.45 or will I take 75.50? What do you say? Everyone give in the comment section. What do you say, guys? Should I take 75.45 or should I take 75.50? Everyone. I am doing a export transaction. So buy. Buy means what? Always remember, I'll draw it over here. Look at this. Left side is always buy. Right side is always sell. Always remember this. So I'm doing a buy transaction. So I'll take the left side. So left side means what? 75.45. This is the rate I'll be taking. So this is for spot, but see here, this is for spot. So 75.45. Now let's go to December 1. What is the rate for December 1 now? Let's look at this. See, this December rates are given as 18, 19, 30, 32, 41, 43. October is 18, 19. Now if you look at these rates, one thing is clear to you. What is it? 18, 19 means what? This, look at this. Whenever you have in any transaction, let me draw a line over here. Otherwise what happens? My video will come, means the writing will come behind my video. Okay, so I'll draw it over here. Up to here I won't write anything. Okay, this part. Got it? Yeah. So now look at this. 18, 19 passage. Whenever you have 18, 19 means whenever you have right side bigger, this side bigger in forward rate. Remember, this is not applicable to spot rate. When you are having this side bigger, right side bigger, the currency is in premium. Premium. Okay. So here, when the currency is in premium, you will have to add. Always remember. And when you have the right side less, then the currency is in discount. Discount. Okay. And then you subtract it. So in this case, what is it given? If you look at this rate, 18, 19, 30, 32. So 18, 19 means the currency is in premium. Right side is bigger. So it is in premium. But what do we want? Do we want this rate, 18, 19 rate? No. We want what? December rate we want it. December start and December end. So now remember, whatever rates are given, if the December rate is given, this rate is for the end of the December. But if November rate is given, it is for the end of the November. October given, October is for the end of the October. Now what do I want? I want the first rate of December 1. Okay, and then I want December 31 rate. So end of December will be December rate. So what is this December rate? 41. So I'll take this 41 paise over here. 41. Okay. Because left side I am doing the buying transaction. Right. So I'll get this. But what about December 1 rate? Is it given somewhere? What is the December 1 rate? Who can tell me the December 1 rate? Which rate will I take for December 1? Everyone. Just give me the answer first. Yes. Which rate shall I take? Everyone. I'll be taking the rate of November end. Always remember, see this, November end equals to December beginning, isn't it? December beginning, right? It's simple. See this, it's like this. Your daily cash in your bank. How many of you are working in cash, have worked in cash? Either working or have worked, right? What have worked or working, anything. So always tell me, what is your day end cash? Today's end cash will be the tomorrow's beginning cash. Simple. Same logic over here. November end rate will be the December beginning rate. What is November end rate now? So November end rate is given as 30.32. So which one will I take? 30 or 32? Everyone. Which one will I take? 30 or 32? Everyone be fast. I'll take 30, correct, left side. So it's always buy. So now I've got both the rates, December 1 and December 31. But I want the December 10 rate. So here what will I do? I'll use buy low and sell high. Now the currency is in premium. So I'll have to add the rates over here. Add the rates means what? What is my rate over here? 75.45 and 30 over here. So I'll add this 30 plus 45. So my rate will be 75.75 over here. And for this, 75.45 plus 41. So 75.86 over here. Okay. So this is my 75 and this is my 86. So what should I use now? Which rate should I use? Should I use 75.75 or 75.86? Who can give me? Which rate will I use? 75.75 or 86? Everyone, be fast. Just now I have written it over here. Buy low and sell high. What am I doing? I am buying or selling? Everyone. Am I buying or am I selling? I am buying. So buying means what? Everyone, buying means which rate? I'll be taking this rate, low rate. So my final rate, not final rate. This is not the final rate. So the rate after this step is 75.75. But if this is 75.75, is this my final rate? No. Why? Because something is more given over here. What is more given here? Margin to be charged 0.05 paise. Look at this. Margin is to be charged for 0.05 paise. So what margin now? So it is directly given in paise. Margin is 0.05. So this much is to be charged. So what do I do now with this margin? Should I add this or should I subtract this? Who can give me? Should I add this or should I subtract this? Margin. I'll write it over here. Margin. This is generally called as TT margin. TT. Okay. TT or this exchange margin. So should I add this or should I subtract this? So remember, whenever you are doing a buying transaction, buy, okay, buy, you will always subtract the TT margin, subtract minus TT, okay. Whenever you are doing a sale transaction, sale, so you will always add TT. So now what am I doing? Am I doing the buy or sell? Everyone just type in the comments, am I doing buy or am I doing sell? I am doing buy, so I will be doing subtraction. So what will be my rate? 75.75 minus 0.0. So 75.70. 5 minus 5, 0, right? 75.70. So this is my final rate. This is my final rate. Okay. Final rate. Now what do you mean by this rate? You need to understand that also. So this, your answer is over. See here, calculate the forward rate to be quoted to the customer. So your answer is over. Answer is 75.70. So what will you do with this rate? Yeah, what will you do? Before going ahead, download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests, whatever you need for clearing JIB and CIB, you'll get it over here. So that's why download it right now. Okay. Chalo. Coming back to the problem, what will you do with this final rate? Okay, what is the amount? Amount is 1,50,000. See this USD 1,50,000. It's given over here, right? 150. So what will I do? It's a export. I'm buying. Buying means what? See this 1,50,000. Again, line over here. Okay. So 1,50,000 into what was that rate? 75.70. This amount will be multiplied. And what is the answer for this now? 75.70 into 1,50,000. Do it fast, everyone. Everyone do it fast. Yes. 1,50,000 into 150 into 00. Okay. 1, 1, 2, 3. So this 1,50,000 into 75.70. So my answer is 1 crore 13 lakhs 1 crore 13 lakhs 55,000. Are you getting this, everyone? What is the answer you are getting? 1 crore 13 lakhs 55,000. This is the answer I am getting. So what will I do? This is in rupees. This was in dollars. Okay. So this 1,50,000 at this rate becomes 1 crore 13 lakhs 50. But what will I do with this amount? This amount I am booking. Okay, so I'm buying this dollars. So I'll give this to the customer. If I'm booking the forward contract, so I won't give anything. Okay, whenever I'm booking the forward contract, I won't be giving it. But if I'm doing the pre or post shipment in this case, then I'll have to fund the customer with this amount. Whenever I'm booking the contract, I'm not giving any amount to this customer. I'm just booking it and taking it a notional rate. Means notional amount over here. Okay. But if you are doing a pre or post shipment, in that case, you'll have to fund it to the customer. Got this point? Got this numerical? This numerical was very important. This numerical is asked for 5 marks. So everyone, welcome to Adda 24/7. We are in the Sankalpa series for BFM. And here we are covering important theory, numericals, objective questions, and various case studies as well. Today we'll be covering the objective part, various important definitions, and we are dealing in external commercial borrowing, ECB, chapter 6 of your BFM. Okay, so let's start without wasting the time. Automatic route. What do you mean by automatic route over here? See this. We are dealing in external commercial borrowing. It means basically the funding part from outside. Understand? Firstly, you need to understand what is the ECB before going ahead. ECB is what? Suppose, let's say I'll give you an example. Suppose if I give you, if I sell some goods, okay, I am the Indian resident over here, Indian or Bharatiya we'll call it now, isn't it? I am a Bharatiya now. I am sending the goods over here, okay, goods, and then getting the money, and then getting the dollars. So this transaction is not an ECB. It's not an ECB. Why? Because here I'm doing business. ECB means what? External commercial borrowing. Borrowing means loan. I am an Indian over here, okay? Indian over here, and I'm just getting the money from outside without selling any goods. Okay? So this is known as ECB. So ECB means basically ECB. It means basically I need not sell the goods. If I'm selling the goods and then getting the money, it means I'm doing a trade. Okay? Keep it very clear in this. Okay? Now let's move on. ECB is under two routes. One is automatic route and second is the approval route. Okay? Automatic means what? For automatic route, the cases need to be examined by the authorized dealer, category 1 banks. Means what? This is basically dealt with by the banks. Now, what is approval route then? For these cases, we need to go to RBI for each and every approval. Suppose if I have to get some loan from some outside guy, okay? So some company it can be. Now that company or any firm who is giving me the loan needs to be FATF certified. It means it needs to be in that FATF certified country, okay country. Okay. Otherwise, what happens? I can't take the loan from each and every person or any person in this world. Okay. That person should be residing in the FATF okay country, you can call it. There are three lists in the FATF. One is blacklist, grey list, and this white. Means grey list and this white is okay, but you can't take it from blacklist country. So automatic route means here the documents for that ECB are checked by the bank itself. RBI does not check the documents over here. Subject to audit. If some bank does some fraud or something happens wrong in that ECB, at that time RBI will check. But under automatic routes, the documents are directly checked by examined by the authorized dealer. And under approval route, the documents are checked by the bank, this RBI. Okay. Next is FCCB, foreign currency convertible bond. Now, FCCB is a convertible bond that is issued in the foreign currency, which means the principal repayment and the periodic coupon payments will be made in foreign currency. This is very important. Here, everyone focus on this. Convertible bond, remember convertible. Okay, convertible means what? This can be converted into. This is a bond. So bond means what? This is a debt. Okay, it is a debt. Okay, so some debt can be converted into equity. I can convert this into equity. Okay, so then it is known as convertible. Okay, so FCCB is a convertible bond that is issued in a foreign currency. So remember, it is issued in a foreign currency, which means principal repayment and periodic coupon payments will be made in the foreign currency. So what does it mean? Suppose I issue a FCCB, means any company can issue it. Okay, big company, not any private limited company. Okay, that who can issue FCCB? That company that is eligible to get FDI. That company can only issue FCCB. So here in this case, if the company issues this FCCB, it means what? It is issuing a bond in foreign currency. It means what? It means the repayment, principal payment and the coupon payments will be made in the foreign currency. So I'll need to issue these bonds in the dollar or pound or any other currency, not in rupees. Okay. For example, an American listed company that issues the bonds in India in rupees has in effect issued an FCCB. Understand this? It's a reverse logic. Suppose if an Indian company issues the bond in USA, then it will issue it in what? Which currency? Type fast. If an Indian company issues the bonds in USA, it will issue in which currency? Will it be issuing it in rupees or will it be issuing in dollars? Yes, everyone fast. Will it be issuing it in rupees or will it be issuing it in dollars? What do you say, guys? It will be issuing it in dollars if Indian company issues the bonds in US. Now look at this. This is a reverse case. In this reverse case, the American company is issuing the bond in India. So in India, rupees are eligible. Means everyone is working with rupees. So in India, they'll have to issue it with this rupees only. Okay. And yeah. So nowadays we call this, call the name of India as Bharat. Okay. Everyone be aware of this. So everyone is coming up with this word Bharat nowadays. It's a very hot topic, isn't it? Yeah. It refers to the foreign currency denominated instrument which is issued in accordance with the issue of foreign currency convertible bonds or ordinary shares scheme 1993, amended from time to time. So these FCCBs are to be issued as per the act. Which act? The act over here is FCCB, Foreign Currency Convertible Bond and Ordinary Share Scheme 1993. Remember, why is this important? Because we will get further topic, that is FCEB. At that time, the act is different. So in exam, they might ask you, this FCCB is issued under which act? So FCCB is issued under 1993 Act, FCCB Act, okay? Foreign Currency Convertible Bonds and Ordinary Shares 1993 Act, okay? Issuance of FCCB shall also conform to other applicable regulations. Further, FCCB should be without any warrants attached. Now, these are two important terms again. See here, firstly, has everyone understood the meaning of FCCB? Meaning, forget all these regulations separately. You must understand the meaning first, right? FCCB is a convertible bond issued in foreign currency. It's that simple, that much. It means now this is the meaning principal and coupon payment will be done in foreign currency. So that's okay. Issued in foreign currency. If I issue a convertible bond in foreign currency, naturally I'll have to pay the interest in foreign currency only and the principal also in foreign currency, right? So you must understand the meaning first. Got it? Then we'll go to the regulations. Regulations are simple. 1993 Act, number one. Number two, issuance of FCCB shall also conform to other applicable regulations. Other means what? Whatever other regulations are given by any of the parties. Means suppose if Income Tax Act gives some different rules, so those should be confirmed with. If SEBI comes up with some different rules, those should be confirmed with. Okay. Further, FCCB should be without any warrants attached. Now, what is this warrant? Warrant means what? It is like the forward contract which we book. Means what? It's as simple. Suppose if I issue you a warrant, understand what do you mean by warrant? Suppose if I give you a warrant, warrant means what? I am giving you a warrant stating that, see, I'll be issuing the shares in future and then you can buy these shares using these warrants. So what are you doing actually? You're giving around 10% of the money or 20% of the money to me. And whenever I issue you the shares or any bonds, so at that time you'll pay me the remaining 80%. So warrant means what? It is just a right to get the further part. Any share or any bonds. It can be for shares also, it can be for bonds also. So what does it say? FCCB should be without any warrants attached. So I should not give you anything stating that this is an FCCB and this will further give you the benefit of some new shares which I am giving in future. Nothing like that. It's simple. FCCB means it should be very simple. This is the loan given by you to me and this is the document which I am giving you. Suppose if you are giving me the loan of let's say $1 lakh, so I am giving you the document of $1 lakh. It means what? It's a proof that it's like that. Let's say FD. What is FD? You are giving, the customer is giving loan to the bank of let's say 1 lakh rupees and bank is giving that 1 lakh FD. It's that simple. On similar terms, this also acts. So FCCB should be without any warrants attached. Okay, no warrant should be attached. A foreign currency exchangeable bond. Now this is separate bond. Foreign currency convertible means what? Just now I told you. Convertible means I can convert this bond into equity in the future date. Suppose if I issue you the bond today of let's say $1 lakh. So further after 3 years, if it's a maturity is 3 years. So after 3 years, I can give you the option that see, instead of giving you that $1 lakh back, I'll issue you the shares of my company, which are of the equivalent amount. For that, my brand value needs to be very big, isn't it? So that is FCCB, converting the same bond into equity. What is FCEB then? FCEB is a bit different. FCEB refers to the bond expressed in foreign currency by an Indian company, the principal and interest in respect of which is payable in foreign currency. Now understand this. Refers to a bond expressed in foreign currency by an Indian company. Okay, the principal and interest in respect of which is payable in foreign currency. Now this is same as that FCCB only. Then what are you saying? You'll ask me the question, sir, what is the difference between this and FCCB then? It is looking at same. Refers to a bond expressed in foreign currency by an Indian company. Principal and interest is payable in foreign currency. So it is same. Then what is the difference between FCCB and FCEB? Here, it refers to the foreign currency denominated instruments which are issued in accordance with the issue of Foreign Currency Exchangeable Bonds Act, Bond Scheme 2008, amended from time to time. See, this is a scheme which I told you, right? So for that it was 1993 and here it is 2008. Now, see this one equity. Let me share this before going ahead. Subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates on JIB and CAIIB. from IIBF. And number two, you are getting the free YouTube series on all the subjects of JIIB and CAIIB. So subscribe to the channel right now. Click on the bell icon. Click on the like button. Share it with your friends. So now, you've got the scheme for FCEB now. So FCEB scheme is 2008. Okay. And FCCB scheme is 1993. But now still the question is there in your mind. What is this difference then, FCEB? See this. FCEB are exchangeable into equity share of another company. See here, this is important. Another company. To be called as an offered company in any manner, either wholly or partly, or on the basis of any equity related warrants attached to the debt instruments. Now, this is a full stop over here. Issuance of FCEB shall also conform to other applicable regulations. Now, I'll explain you this term. What do you mean by this? Another company. For example, suppose if tomorrow Reliance offers, okay? There was recently the demerger of Reliance, right? The Reliance demerged into what? They demerged the Jio Financial, right? Jio Financial. They took a new company, right? Jio Financial was removed, it came out from Reliance now, right? So now if Reliance offers, say this, Reliance offers FCEB to, let's say, some Saudi company, Saudi Aramco. Aramco is a big company in Saudi, right? Aramco is an oil company, right? So suppose if Reliance offers to Aramco FCEB, what will it offer? It will offer this to Aramco that, see, what you do? I'll give you the bond, and against these bonds, whenever you want a payment, I'll give you the shares of Jio Financial. So look at this. Exchangeable into equity share of another company to be called as an offered company in any manner, either wholly or partly, or on the basis of equity warrants attached. Okay. So wholly or partly means what? It can say that if this FCEB is for complete $1 lakh, Reliance can say that complete $1 lakh, complete $1 lakh Jio Financial shares will be given by me to you in exchange of these bonds. This is wholly. Or partly it will say, okay, partly what we can do is out of this 1 lakh, $50,000 will be shares, and $50,000 I'll give you cash. Cash means this basically fund transfer. Okay, so fund transfer or cash, you can say cash. Okay, we call it cash only. If it is fund transfer, we generally call it cash only. Okay, so in any of these ways it can be given. So exchangeable bond means the other company shares are offered, that is exchangeable. And convertible bond means same company shares are offered against the exchange of the bonds. Okay, clear concept? Very clear. Shall I move ahead? Okay. Foreign equity holder. Now, who is the foreign equity holder? It means direct foreign equity holder with a minimum of 25% direct equity holding in the borrowing entity, or indirect equity holder with a minimum of equity holding of 51%, or a group company with a common overseas parent. Okay. Now, what do you mean by this? What do you mean by this? It means that, see this, it means direct equity holder with a minimum of 25% direct equity holding. Now, what do you mean by this? Suppose, let's say, tomorrow, again, we'll take the same example, Aramco, right? Saudi Aramco. Remember, Aramco is a very big company, okay? Aramco, it's related to petrol. Biggest company in the world for petrol, okay? So, suppose if Aramco buys some stake in Reliance, okay? So if it buys directly, see this first step is what? Minimum 25% of the direct holding. So Aramco will buy directly 25% of the shares of Reliance, minimum. So that is known as foreign equity holder with a minimum of 25% direct equity holding, direct. Okay. So if this Aramco has a direct equity holding of 25% in Reliance, it will directly buy the 25% shares, either from the open market or from the Reliance company IPO. This is easy to understand. What is this? Indirect equity holder with a minimum of equity of 51%. Indirect means what? Indirect over here means Aramco will have, let's look at this. Aramco will have what? Number one, it will have a trust. Okay, some name of the trust. Okay, Aramco trust it will have. Number one. Number two, it will have some company, private other company. Okay, in which Aramco is a this director or any shareholder. Okay, so it can have a separate company also, separate company trust. Aramco can also have one company. Huh? Company can be a director of any company also, or a shareholder of any company. So these together buy the Reliance shares. So when these two together buy, they should buy minimum 51% shares. Okay, so this is what indirect. Here what Aramco was doing, Aramco was directly buying the shares of Reliance, but here it is buying through trust and a separate company, and it can have separate other entity also. So any indirectly if they are holding, so it should be minimum 51% of the holding. Okay, that is meant by this. So indirect equity holder with a minimum equity of 51%. That is minimum. Okay, that is foreign equity holder. Or a group company with a common overseas parent. Now group company means what here? For example, let's say, do you know any group company in India which is having the common equity partner, common overseas parent? Okay, there are many as such. Means, for example, many of the companies in India. Okay, for example, I'll give you like the UK, United Kingdom's that royal family. Okay, United Kingdom, that queen they used to call British's queen. That queen has various companies throughout the world, and the parent company is only one, that queen family, whatever same parent. Okay, like for example, Standard Chartered Bank. Then there is another company from UK. Various other companies are there. So all these companies will have the same common parent company or parent holder. So that holder, whenever it's common, it's called as a foreign equity holder. So these are the three main distinctions or definitions of foreign equity holder. Number one, minimum 25% directly. Number two, indirectly 15%. And number three, group company with a common overseas parent. Okay. Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests. Whatever we need, we'll be getting it over here. For clearing CAIIB and JIB exams, what do we need? We need classes, number one. Number two, we need the tests, right? And number three, we need the ebooks, books. So all of the three are available. So that's why download it right now and start studying. Now again, foreign equity holder only. As per section 6 of Income Tax Act, now we are talking of resident. An individual is said to be the resident of India in any of the previous years if, now who is the resident of India? If, number one, resident of India, if is in India for 182 days or more during the relevant financial year. So in any year, suppose if I have to check whether I am a resident of India in last year. So for that last year, I should be for 182 days minimum continuous. Okay. 182 days or more during the relevant financial year. So I should be there for 182 days throughout the year. Continuous. It's not continuous. It's throughout the year I should be for 182 days or more during that financial year. Second, who is the resident? Is in India for 60 days or more during the relevant financial year and has a cumulative stay of 365 days or more in 4 financial years preceding the relevant financial year. Now, this is a bit difficult to understand. See this. Is in India for 60 days or more. Okay. During the relevant financial year. Means suppose if I want to check whether somebody is a resident of India. Okay. For 2020 to 23. That last financial year which is gone. So that person should be there in India for 60 days at least, number one. And has a cumulative stay of 365 days, okay, or more in the financial year preceding the relevant financial year. Means suppose if I want, let's say I'll give you an example. Suppose if I want to check if somebody is a resident in 2022-23. So in that year, this person should be 60 days. Okay. This is difficult to understand. And for remaining 4 years, earlier 4 years means 2021, 22. Similarly, this what 20, 21, 19, 20, and last one is 18, 19. These 4 years, look at this. 4 financial years preceding the relevant financial year. Preceding means back. So during these 4 years, this person should have a total stay of 365 days. Then only that person will be called as a resident. So these are the 2 important criteria. One is 182 days in the previous year. It's that simple. In that previous year or that, suppose if I want to check if anybody is a resident for 20 to 23. So first criteria will be this person should be in India for 182 days totally. Now if this person is not there in India for 182 days, then what will I do? I'll check the second criteria, whether that person is in for 60 days in the last year, in this 20 to 23, and for remaining 4 years, earlier 4 years, whether that person is having the residence for 365 days or not. So this is the important definition of this resident. Okay. So everyone, let me ask you the question now. Resident of India means what? Who can tell me? How many days that person should be there in India? First criteria. First. How many days that person should be for 182 days? Write in the comment section. If you write it, you will remember. And second criteria is 60 days for that year, and before that year 4 years, total 365 days. Okay, that is the criteria. So these were the important definitions to be dealt with. Okay, very important ones, because these always create confusion in your minds. Okay, an individual who does not satisfy both the conditions as mentioned above will be treated as a non-resident in that previous year. So if you don't satisfy any of these 2 conditions, A and B, any of these, it's not A and B, it's A or B, then you will be considered as a non-resident. Okay, and definitely occurs in the exam. I would always suggest follow the complete series. In complete series, we are solving all the important numericals, theory, as well as the objective questions. Okay, so let's start. See this. Numerical is a big one. It will take a long time as such, because there are certain concepts which need to be explained over here. So let's start. On 3/10/2009, your exporter comes. Your exporter customer tenders an export bill for USD 5 lakh, drawn 120 days from the date of shipment. What is the shipment date given? 3/10/2009. Due date is 1/2/2010. Okay. What is the case up till now? Say this. You have an exporter customer. Let me draw it over here. Okay. Let's keep this part separate, because this otherwise you'll face a problem over here by the image. Okay. So let's keep this part and let's draw from here. So what is the case given? On 3/10/2009, your exporter customer has submitted a bill. Bill means what? See here. Always remember one important part over here. Export bill means it's a post-shipment finance. Always remember there are 2 types of finances. One is pre and second is post. In pre-shipment, always there is an order, either order or LC. In post-shipment, there is always a bill. Okay? Bill means bill of exchange. So whenever you see the word bill in your problem, remember it's a post-shipment finance. Whenever you see the case of order or LC, you remember it's a pre-shipment finance. So here it's given what? It's a export bill. Now when I say export bill and when I say post-shipment finance, immediately what should strike my mind? What is the percentage of finance given in post-shipment finance? Everyone kindly answer. What is the percentage of finance given in the post-shipment finance? Just answer it right now. Let me see. Post-shipment finance, correct. Post-shipment finance is always given How much? Post shipment finance is given, always given 100%, 100%. Okay. So here the post shipment finance is given 100%. So on 3/10/2009, your customer has submitted this bill of amount is not that important. Drawn 120 days from the date of shipment. Look at this. It is 120 days from the date of shipment. Now, is this the date of shipment? You don't know. Because this customer has come to your branch on 3/10/2010. So if I take this over here, this customer has come to you, customer has come to you on 3/10. Let's take in 19. Okay, let's keep it simple. Now 09 is very long back, right? So let's make it 19. Simple. Date is hardly of any importance. This 10 will be 20 then, right? Got it? Clear? So now on 19, 3/10/19, this customer has come to you. And what is the shipment date given? Shipment date is given as 3/10, means same date. Look at this. Luckily, these two dates are same. They can be different also. If they are different, remember this date is of no importance. The day when the customer came to your branch is of no importance. Yeah. The date which is important is always shipment date, when the goods have been shipped. Okay. So here luckily both are same. So the customer has come to you on this date. Now the bill is drawn up to what, 120 days from the date of shipment. So 120 days from here. 120 days. Okay. So count 120 days from here. Now luckily in this problem again, see this due date is given as 1/2/2020. So it's already given. If they don't give you this date, then you'll have to calculate it. Okay, 120 days from here. So in that case, you'll have to calculate. Means what? 3/10/2019 to 120 days. So roughly 4 months, right? So 10 means what? 11, 12, 1 and 2, right? So 3/2/2010 will be roughly the 120th day. But in between what happens? There are 2 months which are of 3 months, I think so, isn't it? October and December are of 31 months and January is of 31 months. So 3 days in between, right? Extra days. So these extra days will go back. So it will go back to 1/2/2010. Okay. So this bill will mature on 1/2/2010. 1/2/2010. So this 1/2/2020, let's make it. Okay. 19 it's there, so 20. So on this date, the buyer will pay. Remember, what I mean by this, the buyer will pay. Buyer will pay. Okay. And what has happened on this date, this customer has come to you. So this date, bank will pay. Bank is paying the post shipment finance. Will pay. Look at this, right? So bank will pay up to what date? What date should the bank pay? Bank is giving a finance, post finance, right? Post shipment. Post finance, I'll write it. Post shipment finance, right? So bank is giving this post shipment finance. So finance is given up to what days? Will it give up to lifetime? From year starting from 3/10/2019 to lifetime? No. It will give up to this gap only, right? This is the only gap for which the bank will finance. Because what do we do in bank? In bank, we have need-based finance, right? So whenever there is a requirement of finance, only at that time we finance, right? Others why should we finance? Isn't it? Simple. So now, on 1/2/2010, the buyer is going to pay. Now compute the applicable rate, presuming exchange margin is 0.5%. Look at this. Exchange margin is given as 0.5%. Second, spot repo is given as 48.1415. Premium spot for January is given as 45.46. Rate to be quoted to the nearest 0.25 paise and rupee amount to be rounded off. Okay. Applicable interest rate is 8.5% for post shipment finance up to 180 days, and commission on the bills purchase is 0.0625 to be charged upfront. So now look at this. This problem is of two parts. Remember on basic, this problem is of two parts. What? One part is of forex, and second part is of INR. Two financings are done over here, forex and INR financing. Up to this part, calculate the rate. Okay, rate to be quoted, applicable, blah blah blah. Compute the applicable rate. Up to this applicable rate part, over here you can call it. Up to this part, all the data relates to forex. After this, D part, everything relates to INR. So you'll have to divide this problem into two parts, right? Clear? Now let's solve this again further. So now first what we'll do, we'll solve this forex part first, and this INR part will be solving second, because INR part is simple. It's just a normal loan and that rate of interest is to be calculated. But forex part is important. How much amount is to be given? What is the rate to be given? That is important. So let's solve that first. Okay. So forex part, we'll solve this forex first. Forex. Okay. What is the forex part? See here, today's date spot rate is what is given. Spot rate for today is given is 48.1415. So which one should I take now? Is this export or import? This is an export client, right? So whenever I am having the export client, export, okay, always use the buy rate, buy. For export, always buy. Got it? And for import, always use the sell. So I'll be using the buy rate. But what is the buy rate now? See this 48.14 and 15. So 14. Let's calculate this. 48.14. 48.14. This is always known as the buy. See here, left side is always buy. Right side is always sell. Always remember this. This side is always buy. And this side is always sell. Okay. So that's why I've taken 48.14 over here. Clear everyone? 48.14. Now what is given? Now should I apply this 48.14 only? Here, when is this 48.14 applied? This rate is applied when I am doing this transaction on this date only. 3/10/2019. If I am doing the transaction on the same date, look at this. I'll write it over here. This is known as a spot rate. Spot is always applied on the same day. Same day. If I have to do the transaction, if this bill was maturing, this buyer was paying on this day only, today only, then I would have applied the TT rate. Clear? Everyone getting this? If the buyer was paying today only, means 3/10/19, then I would have applied this TT rate. But right now what is happening? Buyer will be paying after 3 months, 4 months, right? So this is the risk which I am taking. So whenever I am taking the risk, right, for 4 months I am financing as a bank, right? So whenever I am taking the risk over here, this risk, I'll be applying always the bill rate. Bill. Okay. So what is bill rate now? How to calculate the bill rate? So your formula for bill rate is very simple. I'll write it over here. Bill rate equals to spot rate, spot, okay, spot plus or minus here. Now I'll write it premium over here and discount over here. If it is premium, then it is plus. If it is discount, then it is minus. Okay. So what is the plus? What is the case given over here? So this January rate is given as 45.46. Now what is the January rate? January means January end. Always remember this. Whenever any rate is given Jan rate, it means Jan end rate. Jan end. So whatever is at the Jan end, the same will be applied to the February start. Feb start. Okay. Feb start. Okay. So I'll be using what? February start rate. So what is the date over here? 1/2/2020. 1 means what? February start. On first day of every month, I'll be using the same rate which is there for the January end. So February start equals to Jan end. So what is my rate now? Let's calculate the rate over here. See, this rate over here is calculated like this. 48.14 spot plus, now what is this, premium or discount? See this. Right side is bigger. When you are in forward market, this right side is bigger. Always remember it's a premium. See here, right big, okay, equals to premium, and left big equals to discount, vice versa. So right now what am I having? Premium. What is this? 45.46. Right side is bigger. So I'm having the premium. So whenever I have the premium, I'll have to add it. So always use its premium. Okay. So whenever I'm having premium, I'll add it. What will I add it? I'll add the left side only because I'm dealing in buy. So whenever I'm dealing in buy, I'll use buy everywhere. So here, spot I've used it by 48.14. Here, January also I'm using it by again 45, right? So I'll be using this only 0.45. Now add this 48.14 plus 0.45. What is the answer? 48.59. Okay. So is this my final answer? This is the rate to be quoted. But is this my final answer? No. Why? Because here, always remember in any forex there are three parts. One is buy or sell, decide whether that. Second is forward rates. So this is forward margin, means apply the forward margin. And third is always the TT margin. TT or the exchange margin. So what is the exchange margin given over here? See here, premium spot is this and exchange margin, look at this, 0.15%. So this exchange margin is given as 0.15%. Now what to do with this exchange margin? In this exchange margin, always remember exchange. I'll write it over here. Some books write it TT also. Exchange equals to TT. Both mean one and the same. Okay. So equals to, what do I do with this? Whenever I'm selling, applying the sale rate, selling, I'll always add it. And whenever I am applying the buy rate, buy, I always subtract it, minus. Okay. So now I am doing buy. So then I'll have to do minus. But what minus? I'll have to first calculate it. What is the rate then? See this, margin equals to, what is given? 0.15%, right? 0.15%. Percent means upon 100. So it will be 48.59 into 0.15 upon 100. Now some of you might say, sir, why aren't we applying this buy low sell high maxim? You are not using this buy low sell high maxim. So remember, buy low sell high maxim will never be used when the transaction is on the first day of the month or last day of the month. Always remember this. First day or last day, buy low sell high is never used. First day or last day. In between anything is there, then you will be using the buy low sell high. For using the buy low sell high rate, you should always know the two sides of the month. Two sides of the month means, suppose if I have to use the buy low sell high rate, I must know this both the rates, February end and February start. So here February start I am knowing because it's January end, but February end rate is not given. Here, is there any rate given for February end? Right? So February end rate is not given. See here, only January is given. Can you see, anyone can see this February rate? And even though it would have been given, remember, now there is a trick over here. Some books, sometimes in the exam, they will trick you. What will they trick you? They'll give you the February rate also. Then what will you do? You'll do the buy low sell high maxi. But remember, as I told you earlier, whenever you're doing any transaction on the first day or last day of the month, never use buy low sell high. Okay. So what is the rate now? 48.59 into 0.15 upon 100. Calculate it, everyone. What is the answer you are getting? 48.59. Let me see. Let me try it myself also. 48.59 into 0.15% up means what? 0.15 upon 100. Okay, 0.0015, right? So it becomes 0.072. What are you getting, guys? Are you getting the same? Let me see. Correct. 0.072. If you don't write 2, then also it's okay. So what is my final rate then? My final rate equals to, see here, exchange margin I have to subtract, right? So rate equals to 48.59 minus 0.07. Let's take it this much only. Okay, forget this 2. So it is 48.52. So this is my rate. Now what do you mean by this rate? It means that over here 48.52, this rate means what? This rate means I'll be changing this currency at this rate. Means I'll be multiplying this dollar at this rate and then I'll be giving the finance to the customer. So now let's solve the INR part. Next thing what will I do is I'll first let me mark it here because my photo is over here, isn't it? My image. So otherwise it will go behind me. Okay. So now what am I doing? I'm converting this INR. What was the dollar amount? Dollar amount was $5 lakhs. Okay. So I'm converting this 5 lakhs dollar, 5 lakhs into what is the amount I got? 48.52. So 48.52. Now look at this. Important point is given. There's one point given here. The rate to be quoted to nearest 0.25 paise and rupee amount to be rounded off. See, a rupee amount is to be rounded off and rate is to be quoted to nearest 0.25. 0.25 means what? The meaning of 0.25 is it will be like this: 0.25, 0.5, 0.75, like that. Okay, and last is 1. So what is my rate over here? 48.52. So what is the nearest 48.52 0.25 to this? It is 50, right? So I'll be using 50. And always remember, whenever you are using the buy rate, always round it off to the lowest lowest nearer. See here, you can round it off. Somebody can round this off to 48.5. 2 means 48.75 also, because 75 is also near and 50 is more near. But always remember, whenever you are buying any transaction, buying should always be done through the lowest part. Buy equals to lowest near. This is the rate at which I'll be rounding it off, and selling I'll be rounding it off to highest near. Okay, so here what will I round it off to? 48.50. So now multiply this, get the answer. 5 lakhs into 48.50. What is the answer you are getting? 5 lakhs. 5 lakhs means 5 zeros. 1, 2, 3, 4, 5, right? Into 48.50. 48.50. So it is 24, 25 and 4 zeros, means 2 crores. Now crores vagara is very difficult. 24, 25 and 4 zeros. 1, 2, 3, right? 4. Okay, so this 2 crore 42 lakhs 50,000, this is the amount to be given to the client. Okay, now what happened? This dollar problem ends over here. This is over now. Now you have to focus on INR. Applicable interest rate is 8.5% for post shipment finance up to 180 days. Now what is the amount of days of my finance? 120. So these are within 180. It is given up to means maximum. So I can use the same rate, 8.5%. So what will I use it now? See this. This much is the financing I am giving. So what is the rate of interest? Interest I will be calculating. So interest will be equals to what? This I'll just write it now, 2.42 crores, because it is very big. Crores. 2.42 crores into, right? And what is the amount? What is this percentage? 8.5%, right? So 8.5 upon 100. 8.5 upon 100, right? This is my interest. Calculate it again. So what is the amount you are getting? Into 8.5. So into 8.5 means how much? 0.085, right? It is right. 0.085. So it is 2061250. 2061250. So what is the amount? This and this, right? Am I right or wrong? Yeah. 2061250. Right? I think so. Am I making some mistake? 8.5%. Yeah, upon 100, right? Yeah. So 2061250. Yeah. So what is the amount I'll be giving? So it is 20 lakhs and something. So amount which I'll be giving is, okay. Are you getting some different answer? Everyone, just check, because even I haven't calculated. I am doing it first like this, means with you only. Okay. So what are you getting the answer? Everyone, are you getting something different? Let me see it from your side also. Yeah. Are you getting the same answer? Let me see. Into 8. Oh, yes. That's what I was thinking. There's some issue over here. Now, this 8.5% is for what? It is for 1 year. Now, look at this. Very important part. This amount is for 1 year. 1 year. So, this is for 1 year. But for how many days am I financing? This percent is always per annum. I am financing for 120 days. So what will be my interest amount? So actual interest will be 2061250. This is for 1 year into 120 upon 365. Because for 1 year, if this interest is this much, for 365 days, for 120 days, it will be how much? So this I'll have to multiply it with 120 by 365. So it is Let me do it into 120 upon 365. So now am I getting what? 677671, right? 677671. This is the amount. So this interest comes to 6,77,670. This is the interest. But what is given about the problem? There are two things given. One is the interest up to 180 days, and second is commission. Commission is given as what? 0.0625%. So this is to be charged upfront. This is nothing per annum, 120 days, nothing. It is flat. So commission will be 0.0625%. So let's write a commission also. Commission equals to this same amount again, 2.42 crores into 0. What is that? 0.625? Yeah, 0.625. 0.0625, right? This was the commission. Let me say it. Yeah, 0.625 upon 100. Percent means upon 100. Okay, 100. So what will be the answer now? Do it again. So it is, yeah. It is, yeah. 242. Let me do it myself also. 242. Then what? 5 and 4 zeros. 1, 2, 3, 4. This much is my this amount of finance. Now on this, what am I doing? Commission 0.0625 into 0.0625 upon 100 upon 100 because it is percent. So it will be what? 15,156. Are you getting the same answer? 15,156. Are you getting the same? Now remember always, this interest means I'll write it as 1 and this is 2. Both the things. I have to first deduct from the amount to be given to this client. Here, I'm giving this amount to the client as a post shipment finance. Okay. So because here you are over here, this part. Right now we are on this stage. Bank will finance. So if bank is financing, bank will be giving this INR amount, 2 crore 42 lakhs 50,000. Out of that, I'll be subtracting this interest as well as commission. So first add both these. So total deductible, I'll write it deduct equals to deduct. Okay, equals to 1 plus 2. 1 plus 2. What is 1 plus 2 now? 677, 671 plus 15156. Do it. Plus 67, what is that? 677, 671. 677, 671. So it is 692, 827. 692, 827. 692, 827. This much amount is to be deducted. So what does it mean? I'll subtract this amount. So given to the client is given to client equals to 24251234 minus 692,827. So what is the answer? Do it everyone. Minus 24251234, right? So it is 23, 55, 71, 72. 23, 55, 71, 72. So this is the amount which I'll be giving to the client. This much is the finance. But remember, it doesn't mean this interest is charged on this amount only. Here, interest is charged on the full amount. I'm giving the net amount. So this is the amount of finance to the client. So this. The question asked is applicable rate of interest is this. Post shipment finance up to this. Everything is given. So you have to calculate the INR amount also. Both the things are there. It's a big case study of 5 marks. And remember, as it is asked in the exam. Theory is not possible in each and every lecture. But what we'll do, we'll try to cover the important ones. Okay. So first, which question comes to you always is this automatic route. There are two routes. One is automatic and second is approval route. Now, what is this actually? See here. The topic is basically ECB, right? External commercial borrowings. So external commercial borrowing means what? Funds which I get here. Now the question over here is I means who? I am the resident of India. Look at this, resident. Okay, resident. Very important one. I should be the resident of India. And then whatever I get as funds from outside, dollars, okay, the dollars which I get from outside, these will be considered as ECB subject to. I don't do the business. Means if I send some goods and then I get the dollars, means that is basically export. So that should not be the way. Only I'm getting dollars. I'm not sending anything. So that is known as ECB. What do you mean by borrowing? Borrowing means I get money from somebody without giving any consideration. This is known as consideration, right? So here, automatic route means what? Those businesses where government has said that you need not take any permission from any government authority or RBI if you want to get money for your business. But there are specific businesses only. They are not for each and every blanket. It's not a blanket rule for all the businesses. Okay. So what is automatic route? Yeah. For automatic route, the cases are examined by the authorized dealer, AD1 category banks. So what do you mean by this? See here. Whenever the dollars are coming in for automatic rule companies. Now what is automatic route companies? I'll again give you the details. I'm having this. See this. Which are the companies? The names I'm having it. So for automatic route companies, the important part is the documents and the money part, means for what is it coming, that is not checked by RBI. Okay, there are two routes here, approval and automatic. As we have seen just now, I told you approval. Okay, approval, and second is automatic. Okay, in automatic route, the documents and everything is checked by the banks itself, AD. And in approval route, it is checked by RBI. Okay. So, for automatic route, the cases are examined by the AD1 bank only. In automatic route, the foreign entity does not require a prior approval of government or RBI. Because if approval is required, then it automatically becomes the approval route. So that's what is given. These are the leniencies given by the government. Okay. Why are these given? Because there are certain sectors which require constant funds and which are safe, which give the economy a boost. For these sectors, government has given some freedom. Which are those sectors? Let's look at this. Examples of automatic routes. Look at this. Medical devices up to 100%. Why medical devices? Because medication is a basic requirement of any country. Thermal power, right? So power is the basic need. Again, see here, all these are basic infra companies you can think. Okay, up to 100%. Services under civil aviation, such as maintenance and repair organization. So services under civil aviation means aeroplanes. Okay, for maintenance of aeroplanes. So that is also one of the good means. Basically, this is again infra only, isn't it? Insurance up to 49%. See here, insurance is allowed up to 49% only, ECB. Okay. Then infra companies in securities market. Now what is this? Securities market. Okay. Securities market means it includes stocks, bonds, everything. Okay. Up to 49%. Ports and shipping, railway infrastructure. So up to 49%. Okay. So in these infra, railway infra, and even in the pension funds, up to 49%. Okay. Power exchanges up to 49. Now look at this exchanges. Above it was thermal power. This is exchanges. Now what is exchanges? We have various exchanges that deal in power, like we have BSE, NSE who deal in stock exchanges, stock market. Similarly, we have power exchanges also, means commodity exchanges. It can be MCX, it can be others also. Even this NSE and BSE also have their own commodity exchanges now. So these power exchanges up to 49% ECB is allowed. Okay. So understand this. The important is these are, if you look at all these sectors, you'll find one important point. The important point over here is all of them come under roughly infrastructure. They boost the country's economy in one way or the other, right? Foreign currency convertible bonds. Now this is second term. Here, first one was automatic route. Once you study automatic route, immediately approval route also comes in your mind, right? Approval route means wherever RBI's permission is required, right? Other than these sectors, everywhere else we require the RBI's approval. Okay. FCCBs. Now, foreign currency convertible bonds. Now, what is FCCB? Convertible. What do you mean by convertible? Foreign currency convertible bond means a bond issued by Indian company expressed in foreign currency and the principal and interest in respect of which is payable in foreign currency. Now you say then this is normal bond. Even any bond which I issue, the principal and interest, suppose if I issue that bond in dollars, then you'll say what's the difference then? A normal bond and a FCCB. Even if I issue a normal bond, it will be paid in dollars only, dollars and interest, right? So in that case, what do we do? In that case, what do we do? Remember, what is the difference then in FCCB? FCCB means this bond can be converted. Converted means what? Suppose if I issue this bond, I can convert this into other terms like equity. I can convert it into equity of any company if it wants. Means same company, not of other company. Suppose if A company is issuing the bond, then the equity of A company only can be converted. Let's see further. Yeah, before going ahead, subscribe to Officers Adda 24/7 YouTube channel. In this channel, remember, you'll be getting the latest updates on JIB as well as on CAIIB. Plus, you get free YouTube series. Now, right now, what are you watching? You're watching the free YouTube series on Sankalp series on BFM. Similarly, you'll get free YouTube series on all the subjects. So that's whatever is free, grab it fast. Subscribe to it now. Subscribe to the channel. Click on the bell icon. Click on the like button. Okay. Next, same FCCB continued. It refers to the foreign currency denominated instrument which are issued in accordance with the issue of foreign currency convertible bonds and ordinary shares scheme 1993 as amended from time to time. Now this is the scheme given which the government had brought in 1993 scheme, amended from time to time. So it is issued in accordance with this FCCB and ordinary shares scheme. Okay. Issuance of FCCB shall also conform to other applicable regulations. Further, FCCB should be without warrants attached, any warrants attached. Now, first I'll explain you what is FCCB, because that is very important, isn't it? As I told you over here, suppose a bond is issued by a company, okay? Then what does a company do? See here, if it's a normal bond, let's consider it two ways, okay? One, a normal bond, and second is FCCB. Let's consider it that way, okay? Let me remove this, yeah. See this. Now let's consider it two bonds. One is normal bond, second is FCCB. So what happens? This is a normal bond. Normal bond in dollars, okay? Normal bond, and this is FCCB. Now this is normal bond in dollars. So what will happen? Normal bond means I issue the bond. I have issued this bond. Both, let's say, both are issued. Nothing is purchased. I issue, here also I issue. Okay? So what is the difference now? Suppose if this bond is for, let's say, $1 lakh. $1 lakh. Okay? Same bond over here, $1 lakh. Okay? Now what happens? When we say it's a bond, I have to pay two parts. One is the principal, face value, at the end, maturity. And second, I have to pay at a coupon. Coupon, right? Every year, every 6 months, whatever I have agreed. So both these things I have to pay in dollars. This also dollars and this also dollars. And the important point is, I can't miss out on any one of these, right? So this is basically normal bond. Now what happens in FCCB then? In FCCB, when I issue the bond, I'll give a conversion point over there. Conversion means what? I can tell that customer, whoever has bought this bond, that instead of giving you the coupon every 6 months, every 1 year, what I'll do? At the maturity, I'll give you entire amount, and along with the interest arrears. And if I'm a big company like Reliance and I issue that FCCB, what will happen? To that person, whoever has bought this bond, I'll tell him at the end, at the maturity, that's here. Now this 1 lakh has grown to, let's say, 1 lakh plus total coupon. It has grown to, let's say, $30,000 again next. Okay. So now I'll tell this person, now I have to give you $1,30,000. So instead of this, what will I do? Instead of giving you $1,30,000, I'll give you, convert this into equivalent amount of shares of my company. Shares. Okay. And these shares, I'll issue it to you. Now what has happened? There are two advantages. One, the number of shares of my company has increased. Okay. So my capital increases. Second, I don't have to forego this cash now. So that is the advantage of FCCB. In normal bond, I have to give this 1,30,000, whatever it is. Okay. So that is the advantage of FCCB. But any customer will buy FCCB when, or get it converted to shares when your brand name is good. Suppose if you are Reliance, you are Tata, you are let's say this what Adani, let's say Wipro, all these names, if you have this, then the customer readily agrees for the FCCB bond. But if you're a small company with a bad reputation also, big company with a bad reputation, that can also be the thing. In that case, FCCBs won't work. Okay. So issuance of FCCBs also conform to applicable regulations. Further, FCCB should be without warrants. Now, what is this warrant? What is this warrant? Everyone has seen Hindi movies. Hindi movies, everyone has seen. In that, the police inspector comes or the hero comes, right? Goes to the villain's big house. Generally, that's the picture. Villain is in a big house, staying somewhere. Hero is the police inspector, right? So hero goes there and tells that villain that, see, I have come to arrest you. I have a warrant with me. What do you mean by that warrant? Same warrant continues over here. See here, meanings never change. Only the terms change as per this market in which we are dealing. Okay. It means that person, that the inspector has got a right to catch that person and take him. Right. Remember this word, right. Same thing over here. When I say warrant, what does it mean? Suppose if I issue a warrant to you, okay, for shares. Let's say I've issued a warrant for 100 shares. Okay, 100 shares, I've issued a warrant to you. What does it mean? I've issued you a paper in which you have paid me certain amount. You have paid me certain amount. So this certain amount, let's say 25% you have paid me. So that's why I issue a warrant to you and tell you that, okay, remaining 75% you pay me later and you have a right to buy these 100 shares. So whenever you come to me on maturity date, I have to compulsorily give you these 100 shares. Of course, after taking the 75% amount. Okay. So that is known as a warrant. Warrant means it gives you a right to buy those shares or any commodity, wherever you get the warrant. Okay. So that is the basic logic behind it. FCEB. Now this is, earlier we saw FCCB. What was FCCB? FCCB was my company, my shares. Let's keep it very simple. Okay. Let me write it over here. FCCB versus FCEB. I'll make it very simple in this. FCCB versus FCEB. Okay. So it means like this. My company, my bond, let's say, not company, my bond, my shares. So you give me my bond, I'll give you the shares of my company. FCEB means what? My bond, other shares means other company shares. Other shares, let's write it simple. Now this other shares means what? Other company shares. It means what? This is generally the sister concern of this my company. Suppose if I am Reliance, then under FCEB, what will I tell that customer? That see, on maturity or in between also, if you want it, as per the terms, what will I do? I'll give you the shares of not my company Reliance, but this is my subsidiary company. This is other company. So I'll give you the shares of that. Look at this. FCEB are exchangeable into equity share of another company to be called the offered company in any manner, either wholly or partly, or on basis of any equity related warrants attached to the debt instruments. Here also warrant, arrest warrant, right? Hero, villain, warrant means right? So FCEB means what? Here again, get the logic same, clear. Okay. FCCB and FCEB are roughly same, 90% they are same. Only 10% differences. My bond, my shares. Here, my bond, other shares. Sister shares or my brother shares, whatever you can say. Sister concern, brother concern, you can say anything. Under company. To be, that is called as offered company. Okay. So if Reliance offers, let me take this example over here. Suppose if Reliance offers the shares of Geo Financial Services. You know this now, Geo Financial. Okay. RIL issues the bond. RIL issues the bond. FCEB. Okay. RIL issues FCEB to Aramco. What is Aramco? Aramco is a company of Saudi Arabia, biggest company oil producer in the world. Now RIL issues a bond to Aramco, FCEB. Okay. And what happens? It tells Aramco that in exchange of these bonds, I will give you the shares of Geo Financial Services. Geo Financial. Now you understand the deal. Okay. So these shares I'll give you in return of this bonds which you are holding. So that is known as FCEB. Okay. Got it clear? Everyone, download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, test, everything. Whatever you need for clearing JIB and CIB, you'll get it over here. Firstly, tell me what do you need for clearing CIB? Tell me. One is lectures. So you have e-lectures over here, video lectures, recorded live, all. Then you require books. So ebooks are available. Then you require tests, right? So tests are available. What else do you require? That much is enough. Okay. Don't study too much. Okay. Yeah. Be focused. You have to clear the exam. That should be your focus. Okay. So that's why download Adda 24/7 app right now. Issuance of FCEB. Now we'll discuss FCEB in a bit detail. Okay. Issuance of FCEB shall conform to other applicable regulations. Now what are other applicable regulations? See here, I'm giving shares. So other regulations means under shares what comes, SEBI comes. Okay. So SEBI will be applicable. SEBI's rule will be applicable to you. So that is meant over here. Okay. Because here I am dealing in shares. Against these warrants or against these bonds, I am giving some shares. So the SEBI's rules will be applicable. It refers to the foreign currency denominated instrument which is issued in accordance with the issuance of foreign currency exchangeable bond schemes 2008. Now look at this. FCCB was 1993. This is 2008. Means after 15 years FCEB were introduced. Long gap, isn't it? As amended from time to time. So FCEB scheme is in 2008 and FCCB scheme is in